You know, it's interesting when you talked about edge in these niche programs. You know, I look at, you know, how about just the delivery processes for some, you know, commodities traders, whether it's grains or metals. Um, it's not a terribly complex product or process, but if you don't know the ins and outs of it, oh, like there's an incredible amount. Like you need to be informed with it, and yet there's these small little pockets of, you know, where you can be specialized and unique and really become a consistent earner and bank return, you know, month after month. Chris, do you have any comments about that?
Yeah, I think what's interesting about what Neil has said, it's I think it's really proven, right? When if you can be up in 2019 and in 2020, I feel like these, well, 2020, the Nasdaq is already up to its high water mark for the year. But in general, if you can be up in 2019 and the first quarter in 2020, that to me is a real hedge fund. It's like looking at 2008 and 2009. That was the old measuring stick to say, wow, to make money in back-to-back years, you either had to have a very tactical view or had a truly orthogonal strategy that's independent of market direction. It's
And Chris,
interesting.
we were up in 2018 also. I mean, 2018 was a tough year for not only
Yeah.
hedge funds, but for the broader markets as well. I mean, our business is making money all the time, you know, as smooth and as steady as we can. Now, we're not going to make 20% a year, but, you know, anyway, I didn't mean to interrupt you. I just wanted to make that point.
Sure.
2018 is also another good example.
Yeah, no, I get it. This is exactly what we all say we want. And it's interesting when I talk to a lot of managers, and I talk to managers across the spectrum, from large to medium to small, often the pitch is that exactly as Neil gave it, independent of market direction, orthogonal, et cetera, like all the nice buzzwords. And in practice, so few are, because if you are trading financial instruments, you're going to be correlated to financial situations and financial liquidity. And a lot of the managers, whether or not they could be market neutral, they are correlated to liquidity events, and that's exactly what we had in the first quarter. So to find a fund like Neil's is surprisingly unique within the hedge fund universe. And I've looked at, you know, thousands of managers over the years, and most of them are selling more beta than they are alpha.
I'd like to talk a little bit about that with you, Neil. So when you're constructing a portfolio, when you're finding these managers, is there an overall fit, an overall view, or does it really just break down to, hey, listen, we're trying to find someone with a unique edge and we'll figure out a way to get it to have it fit?
Yes, the latter. We're trying to put together an internally uncorrelated source of positive expectancy investments. It's as simple as that. So if you've got positive expectancy and you're not overlapping with the same positions that somebody else has got, you know, congestion trading across the electricity grid and cryptocurrency arbitrage, you don't have to be a rocket scientist to realize there's zero correlation between the two, irrespective of what math ends up saying. But what I'll also mention is, so what do we do to find this? So, you know, and being in the hedge fund business now for 25 years, when I started in the hedge fund industry, there was collectively $50 billion invested in hedge funds. Today, there's north of $3 trillion invested in hedge funds. So we don't invest in these niche strategies or these esoteric strategies to be fancy or to, you know, get our name up in lights or to be cool. We invest in those strategies simply because we think the demand-supply equation for inefficiency is more fertile, given that out of the $3 trillion that's invested in hedge funds, you know, 90 plus, Chris would know better than I would, but 90% plus of that money comes from the largest allocators in the world, the institutional allocators. And by definition, because of their size, because of their bureaucracy, their bucketing, they just can't invest in these more niche-y, often capacity-constrained managers. And so I liken it to fishing. You know, we're trying to fish in a pond where there's 5,000 fish and only 5 guys that can fish in that pond, whereas most allocators are fishing in a pond where there's 5 fish and 5,000 people that are trying to catch those fish because they're too big, they have to be in the mainstream securities, they have to try to find edge in US equities or European equities or fixed income. And there's just too many edge demanders and not enough edge suppliers, especially the way the world has changed, where the more active traders have gone to more passive indexation and ETFs. So you've got a bunch of the smartest poker players in the world trying to play against the other smartest poker players in the world. That's not a fertile playing field for me. I want to be where the weekend warriors are playing. So you have to have the palette. You have to have the ability, based upon your investor base, to operate in this manner, to find what you mentioned. Somebody who's doing something very nichey. His AUM might be, or his or her AUM might be $20 million. They've got this unique little inefficiency that they're capitalizing on. That's just uninvestable by 90+% of the hedge fund allocators out there. So you have to have an investor base that allows you that flexibility to be able to take advantage of those opportunities. And that's actually pretty rare. And that's part of the edge that we're taking advantage of, because, we want to play, we have that palette. We have that ability to operate more like a family office than we do, an institution. Oh, this doesn't fit into a bucket, Anyway, I think I described, I don't want to yield the whole, I want to take up the whole time.
No, well, I want to hand it right off to Chris then, because, how do you, fish into that pond now with, Neil is correct in my opinion about the bigger allocators. It's hard for a guy that's taking delivery on grains to, where he's got a capacity of, let's say between 20 and $40 million. How does that fit into a portfolio that you're designing? Are you able to take that type of manager and use him, for the overall good of the portfolio?
Yeah. So in general, our clients are some of the, the biggest, largest institutional investors, some of the public pension plans. We have about 50 clients at the firm that range from medium-sized ENFs to small, to large public pension plans. And unfortunately, just because of size constraints, we fall in that 90% of the investors that cannot invest in managers that are under $100 million. So the way that we try to get around this is investing in multi-strategy firms that might have pockets of reinsurance or specialty finance or opportunistic relative value. We can get that indirectly, but we are not playing it directly. And I think that certainly creates challenges, because they are not able to fully create a portfolio. The large multi-billion-dollar multi-strategy funds don't have portfolios that are truly independent of market correlations, because the strategies are just too capacity constrained. So we try our best to figure this out. The flip side is that the other argument that we haven't talked about is simply that a lot of these strategies, these are the ones that are almost binary, that can go to zero. So I think a lot of the comfort you have with some of the larger managers is that they probably might not make 20%, but perhaps they won't lose 20%. And the volatility becomes, when it becomes a line item at the public pension fund level, there's significant scrutiny at every single level. So I'm not necessarily defending it. Just being in this world for a decade, I truly understand why we can't be invested, because the scrutiny is just too great. I think almost every line item, the hurdle rate is for a Sharpe ratio of 1, right? As diversifying as it is, if it can't be a little more consistent, then it is, ultimately gets voted out and picked on until it gets voted out. So these are some of the constraints at the public pension fund level and at the institutional level that perhaps prevents from opportunistically investing in all of these, fantastic esoteric strategies, which when you lay it out on paper, it adds up, it's completely uncorrelated. Well, that sounds fantastic. In practice, it's much harder than it looks.